Hey traders, Nick Shaheen here looking at the TLT, which is the ETF for 20-year bonds. Not the yield, the actual bond prices. So typically when this rises, stocks fall. If you think about it, they always say, what kind of balance do you need between stocks and bonds? Because they are, in theory, competing for investment money. You can either buy bonds and collect the yield, or you buy stocks and try to make better yield for yourself. So they are inversely related. So if this rallies, the stock market falls, and vice versa. And you can see that it spiked into December, therefore putting pressure on the markets. Anyway, long story short, today's video is to see if I can share how I would go about looking at a chart and evaluating a thesis. I got a question from last night about basically they've been looking to do a TLT bull put spread, so they want to sell risk in below current levels for TLT, so they're betting that there will be support in bonds for the bond prices, which is not a bad theory, because if you think about it, our bonds are probably the only bonds that actually pay a yield, whereas in Europe it costs you money to put and in Japan, I believe, it actually costs you money to buy a bond. So instead of the government pay you back for lending it money, they'll take your money and they say you owe us more money for us taking your money, which is ridiculous. So that presents the TINA, that there is no alternative bid to our bonds, and that's why our rates are not going to go anywhere, because if the bond price are rising, they cannot rise. Those are also inversely related. Think about it, that if you have something to sell and it's hot, people are buying it, why would you make it more attractive for people to buy it? So you drop the rate. So anyway, they wanted to see how I approach it with regards to charts. So the thesis is set. Bonds should have support for the long term, and their time frame with the question was, I believe, May. So in theory, I believe in that. So let's see if the actual technicals agree. So this is a daily chart, which is what most everybody looks at. There are already lines on there, and I'll explain them later. But so this is a good start. Part of the question was, there was a discussion, and part of the question was, which time frame do I look at? They asked the daily, the hourly, the weekly. I said yes, because it's all of them. It's never one slice. There's always more clues. So this is one, the first default that most everybody has, and we can see I had an up arrow here, because I said if this is broken out, which is a zone, not a hard line in the sand, bonds will spike, and indeed they did, and we had a little tizzy. So now it's given some back. Maybe it's time to sell a credit put spread. The credit put spread is a bull put spread, also called. Basically, I'm selling risk and betting that price will not fall below a certain level. I'm not going to share the actual trade. I'm just sharing the chart and say, okay, this might be a good place to do that. So it's falling. Is it a catch a falling knife? So I can tell you right away that it could be a place where it slows down. Again, this is not a hard line in the sand because of how it trades, but it's falling into a zone that was pivotal. What does that mean? This zone right here, specifically this line right here, is where bulls and bears agree the most on price for the last year. More so this period of time and that period of time. Okay, we went down here and we went up here, overshoot, somewhere in the middle lies the truth. So just from that, saying that, as it falls to here or into this zone, the bulls and bears agree on price, so they're going to fight it out more, which will create congestion, which is support on the way down. If it was rising, it'll be resistance. Like on the way up, it hit this area and it was going to be resistance, and sure enough it was resistance, and then boom, they decided to go up. So on the way down, it is possible that they do the same thing, likely I should say. So if I wanted to sell a spread, I would sell it down here. Okay, so this is a spread out in time. So what if I wanted to get more granular? So this is the one look. So then I start changing the time frame. First of all, I want to look at the overall big picture. That's a weekly chart. Same ticker. So now the circle, the lines, the area, that looks like it's a pivotal zone for over 5 years. You see, this was the zone we were talking about. I'm going to change it to a monthly chart. Okay, so this is the zone we were talking about. It's been pivotal since 2008 when we had the crisis. So the stocks collapsed. Look what happened to bonds, right? So it's pivotal for a really long time. So our assumption, my assumption here, my statement that this is a support zone, that's the same zone right here. This zone is support because it will bring congestion. So if I want to sell risk below it, I'm not an idiot for doing so. All right, so what else do I do with time frame? I just moved up time frames. What if I move down? So I'm going to go to a 30-minute time frame. So that gives me more minute movements. That's the same blue line we were looking at before. And I'm looking at, okay, so I may want to sell risk below because of support. I'm not too excited about buying calls until they break above 122.7. How did I choose that? Because I see there was a gap down, which says this is a fail zone right here, is a neckline, an accident. And they tried to break through it the last couple of hours and they failed. So I'll put an alert. If it goes above 122.7, wake me up. And then I'll start looking at it again. And then the next alert I would put is somewhere around 123.25. Why? Because this was the lid from the prior accident, which happened right here. So you see I have 3 accident scenes, 1, 2, and 3. And I'll put alerts to see when I want to chase it up. Now I can tell you that this is a descending wedge now. So you know, if the fall stabilizes, at some point I would have to see a bottoming process where they're not setting lower lows, just lower highs. So lower highs, no lower lows. It'll come to a point, and then either this or that, and then you play your level. So to answer the question at hand was, would I sell puts or put spreads, not selling puts naked, put spreads in the TLT? That is a viable thesis, and I just showed you why. And as far as the levels, then I would have to go look at the actual premiums that are available to determine whether I want to do a $1 wide, $2 wide, 50-cent wide, whatever is available. All right, Nick signing out. If you have any questions, let me know.